Hello, I'm Daniel Barr-Waanders, Head of Data and Research here at And Property. And today we have the privilege of speaking with Faris Dedic, the Managing Director of Dig Capital and a key player in the finance space. Faris brings a wealth of experience in funding and advisory services with a strong focus on industrial real estate. We're going to dive into some fascinating topics, exploring everything from the impact of finance on the industrial property sector to how AI could shape the future of Melbourne's industrial and real estate market, and the effect of debt markets due to the upcoming federal election. Faris, thank you for joining me today.
Faris Dedic, I'm the Managing Director of Dig Capital Advisory and Koi Capital Management. Predominantly in the Dig Capital Advisory space, we have two sides to our business. We have a corporate finance team, and we have a property finance team, and our capital management side of the business manages capital, with our core product being private credit. I mean, if you look at it optically, what we do is we support business owners, property investors, property developers, and emerging family offices navigate the debt market and the capital landscape. Our core transaction sizes that we work within are about $1 and $150 million as a single transaction, and the portfolios where we add a lot of value to our clients. Clients who have property portfolios between $5 and $250 million. I mean, the core of the business is really just to navigate the financial landscape and add value to our core clients. My personal expertise comes from a structured finance background and getting capital stacks and capital products to work for our clients.
Faris, what was your macro overview of 2024 from a debt market perspective, and what challenges did you face, and what were some of the surprises?
2024 was a very interesting year for us. Obviously, globally, the debt market saw a surge in corporate borrowing levels, record levels of debt were written into the market. Predominantly as an overarching theme, clients weren't necessarily looking for debt for new projects. They were looking for debt to refinance their current debt obligations on better terms. Locally, we obviously had a turbulent year, 13 interest rate rises in 15 months. That caused a lot of credit providers in the market to really shift their credit policies, their structures, their underwriting parameters, their underwriting processes, which then caused a lot of gaps in the market for new lenders and entrants to come into the market. I was reading in the Australian, the Financial Review the other day, that now there's over 600 non-bank lenders in the market. So it's showing that the markets, those interest rate rises and I guess the change in credit policies has forced competition into the market, bringing more lenders into the market, driving down the costs of financing. I mean, the challenges that we faced at Dig Capital Advisory, the biggest challenge we faced was really the valuations, was navigating the valuations that our clients were getting. Obviously, with the corporate finance and the property finance sides of the business, they had different challenges. Corporate finance side of the business, trading businesses had more challenges coming out of COVID with labor shortages, supply chain management, stock management. But in 2024, we really saw the property side of our business face challenges because our property developers and investors were in an environment where borrowing costs have never been higher, financing costs have never been higher, and valuations have never been lower. So their equity was compressing over time. It was forcing our property investment clients to potentially have to come up with more money to maintain their LVR covenants that they had at their banks, or we'd have to restructure them. And then our property developers couldn't lean upon those uplifts in valuations they traditionally did to be able to build liquidity into their portfolios.
And would you say like your clients were a bit more selective with the asset types and the
Absolutely. Coming out of, COVID and the lockdowns that we had in Melbourne particularly, there was a mentality where everyone just wanted to buy anything, and there was a lot of liquidity in the market, and that drove a lot of cost escalations in all asset classes. But no one could have predicted that we would have had the interest rate rises as quickly as we did, and in the cadence and the speed that we did, and that really caught the market off guard. Back into 23 through 24, we saw clients hold on to cash more, looking for that deep trough in the market where they could enter the market and drive upside for the next cycle. But they were just selective. Residential developers returning around, they're looking at industrial developers returning around looking at childcare assets. There are new entrants into the market.
So there wasn't really like one opportunity, like one asset class that really like spoke volumes. Like for instance, like 2022 industrial was the thing.
Yeah.
And now
with 2024, we probably wrote the most, if I look at just property development and I look at what asset classes we wrote the most, I guess transactions against as opposed to volume written, I'd say that childcare was really a standout. It was amazing. We were writing at one stage 4 to 5 childcare transactions a month, whether it was acquisition, whether it was construction, whether it was refinancing of the completed product. That was really a standout. But, you know, 24 was really a year where everybody was finding their feet, I would say. At a capital management side of the business, I wouldn't say there were challenges from, the biggest challenge was really getting investor money to work for them the right way and taking the right amount of risk. Like, it's very interesting through 22, 23, 24, and generally in the private credit market. Sometimes investors are getting the same rates of return for construction risk and for bridging finance risk. And the biggest challenge for us was really to deploy capital for the right risk return profiles and ensure that we're not writing any loans where we're stuck or where the markets are liquid. But overall, it was a very dynamic year in 2024.
What does the debt market think of the industrial sector as an asset class, and how does that impact what industrial investors should be aware of when assessing their finance options?
To answer the first part of that question, like you said before, 2022 industrial was the golden child of Australian property, right? And if we exclude data centers specifically, which are their own asset class within the industrial property sector, industrial property as a whole saw a lot of liquidity come behind in 2022. That sentiment drove through in 23 and 24. You have to look at it optically. Debt markets are looking for the highest amount of return with the lowest amount of risk. So industrial property for the debt markets overall presented the lowest amount of relative risk compared to other asset classes in Australia through 22, 23, 24, 25. What that meant was that a lot of credit policies lightened up from the capital providers in the market, whether that was the debt market or capital providers or lenders were happier to take lower interest cover ratios on some transactions. We're happy to leverage up a little bit higher. We're happier to build more flexibility in their capital structures to support industrial property investors and developers. It meant that there was a lot more capital sitting behind what was traditionally a lazy asset class. What that means for industrial property investors is that there are more options than what they had in 2020, 2021, 2022, and 2023. Generally, the lending market takes a little bit longer to adapt to an asset class and takes longer to have a material impact on the liquidity within a particular asset class. But it means that industrial property investors have more options. If they haven't, assessed their portfolios over the last 2 to 3 years, they should see if they can get better interest rates, better leverage ratios, release some security, free up some liquidity in their portfolio, potentially reset their portfolio, trade some stock, unlock some land values, create market uplifts, use these debt instruments, which have never been more prevalent in the industrial property sector, to add value to their assets.
And why would you say, when you said that it took a bit of time for the lenders to catch on to the trend of industrial, let's say in 22, 23, why is that? Why does it take a bit more time?
Well, for us in a debt advisory space and I guess and property as well, we hear it straight from the street, right? So in January, we feel January. In February, we feel February. In March, we feel March. Generally, what lenders do is they adjust their credit policies on reports or on market trends or market analytics. To get those trends, usually that trend reporting comes out in arrears. So what we see in January generally gets reported in March, and then generally has a material impact on credit policies in, say, June, right? So there's this 5 to 6 month lag for the credit market to move to what's actually happening on the street. And that's for good reason. Sometimes what we see are fads or trends or hot and cold markets that don't need credit markets to adjust and move too quickly too. But, overall, if you look at 2022, all of that boom that industrial property saw across Australia in 2022 was then translated in lighter credit policies through 2023. And that's where the credit market was at the moment. Now that we're seeing, I guess, industrial come off a little bit, we'll probably see finance maybe tighten up a little bit next year, or see a little bit less leverage on vacant land or land sites in the market, but that's generally why the market's a little slower to react.
Yeah, also like with the Q1, Q2 reports, you're basing off the previous.
That's right.
And that only gets released every 3-4 months.
So. That's right. Absolutely. What is interesting though is, like I said before, there's a lot more non-bank lenders coming into the market. So what's happened is, whilst some lenders might pull down their leverage ratios or compress their leverage ratios, where they would have traditionally lent, say, 70% against the development block of land in the industrial market. If they're now at 60, we're seeing that new lenders are entering the market that are still happy to hold that 70% position. So It'll be interesting to see what impact new competition brings into the market. But yeah, right now it's pretty status quo.
What are the core drivers industrial property developers need to be conscious of from a finance perspective? Previously, the banks had strict pre-sale conditions and required substantial equity.
Pre-sale conditions and substantial equity applies in, I guess, two main phases of any property development. Substantial equity is generally required to buy the piece of dirt or the block of land or the opportunity. And then pre-sales are generally required when you're going into construction financing. From a core driver standpoint, if I take an optical step out and I look at it from a market standpoint, traditionally we saw industrial assets as fast-moving assets. So a gumboot developer would come in, hands-on, they would buy a block of land, they would fund the permits themselves. They had their team that came into it, their architect, their land surveyor, their whole team would come in, they'd build the thing in 6 months, at least the thing within 2 months of completion, and the whole project would be in and out within 24 months. We're seeing that time frame take significantly longer now. So, with planning delays, with infrastructure delays, with services delays, with delays in terms of reporting. So EPA register reporting, cultural heritage management plan management, Melbourne water, all of these lags are starting to have an impact on the timeframes of these developments. So traditionally developments that took 24 months, we're now starting to see take 48 and sometimes more months. So I guess that's the biggest core driver you would see in terms of what property developers need to be conscious of. Pre-sales are not as prevalent and existent in the market as they are right now. It's actually quite rare to have a project who's fully pre-sold out of the market, unless we're seeing industrial developers who are doing land subdivisions, and they seem to be able to get away a fair few blocks of land before they starting. But from a financing standpoint, pre-sales really aren't a thing anymore. We're getting the major banks coming into the market. Our guys are getting major bank deals at 65% LVR coming out of the ground with 20% debt coverage ratio, whereas traditionally we want to see 100% debt coverage ratio. We're seeing non-banks financing construction deals at 70 or 75% of the end value of the project with no pre-sales. What I would say industrial property developers need to be really conscious of is getting the right loans for the right stage of their project. So if you're getting an acquisition loan, get it to acquire the block of land, right? If you're getting a construction loan, only get it for the construction piece of the property. Don't use it for residual stock. If you're getting a residual stock piece, get it for a residual stock piece. So that's where we're seeing that's the core drivers that we believe property developers really need to be conscious of.
Are you saying, can you see like any precincts that are, leading the way in terms of, there's like e-commerce growth and the supply chain resilience and the rise of AI?
Yeah. Well, what supply chain? So obviously, if we look at just trends and 24-month trends, through Corona, after Corona, everyone was looking at onshoring versus offshoring, and we had labor shortages. So there was a massive expansion of how much storage space businesses needed. That then put a lot of pressure on leasing, which you'd know better than I do. I'm not a property guy, but we work obviously in the space. Vacancies dropped to all-time lows. We then found efficiency. Offshoring became a thing again, which will be interesting to see now with tariffs and these changes, what sort of an impact that will have. But vacancy started creeping up a little bit more, where we found some sort of stability in the market now. What we have seen though is that AI is bringing efficiency into supply chain management. Last mile distribution is really a trend. Sites that are located very close to transport hubs, ports, rail stations, major arterials, they are getting asset uplift valuations. And I think that trend will really continue through the next 10 to 20 years to come.
Yeah, it's quite interesting. I was reading this case study where there was this owner-occupier. He had a warehouse of like 5,000 square meters, and he's like, I've got no more space. I need to buy a bigger space. I need like a warehouse of like 8,000 to 10,000 square meters. And then a group came in that, specialized in efficiency. They came in, they said, why don't you just, lift up your roof, make it go higher, and then when you can start stacking and just optimizing on your racking.
That's right.
Yeah.
But we're seeing that in data as well. So traditionally you'd see data centers would need larger footprint and they need larger rack space, and they'd be designed very differently to what they are right now. And now we're seeing some data concepts that are coming to the market that are much smaller floor plates, and they have just more efficient racking and stacking systems. So it's amazing to see what's happening with an industrial standpoint. What I do think macro trend is that there will be a lot more smaller businesses in the market, a lot more subcontractors over the next 5 to 10 years. So I do think there's going to be more place in the market for 1,000, 2,000, 3,000 square meter owner-occupied premises, whereas traditional that we're servicing large contracted companies. So it'll be interesting to see that mix between new coming businesses that are looking for owner-occupied stock, that's smaller footprints, kind of starting their businesses, riding on this next wave or hopefully this next cycle. Yeah, correct. Yeah, correct. So it'll be interesting to see what happens. But yeah, time will tell.
A lot of our clients have traditionally stayed away from non-bank lending. What are some pros and cons for receiving funding this way?
Yeah, well, non-bank lending had a preconception really until a couple of years ago that it was, if you're borrowing money from a non-bank lender, was the lender of last resort, right? Which is no longer the case. We take the house view at Dig Capital Advisory that non-bank lending is a very important part of a client's portfolio. We're not saying that it's the whole client's portfolio, but it has a very important purpose within a client's portfolio. Especially clients who are active, who are looking to trade stock. You know, our traditional clients, we'd put all of their trading assets with non-bank lenders. So if they're acquiring land, we'd use a non-bank lender and give them 70% leverage instead of 40% leverage that we'd get through a bank. Or if they're constructing, we'd give them higher leverage at 70% versus what they normally get, say, 50% from a bank, although that's changing. And their core portfolio would stay with a major bank. So what we're seeing now is that there's a big shift in terms of how we advise clients on non-bank lending and where non-bank lending sits within their whole portfolio and their capital stack. Biggest pros: speed, reliability, service levels. Generally, non-bank lending is written by guys like us who are advisors. So you have a relationship manager, a broker, or an advisor who communicates on your behalf to these non-bank lenders. So these advisors generally know their non-bank lenders' credit policies, know your portfolio more intimately. So you're getting a lot more tailored financial advice as opposed to just you trying to to communicate with these non-bank lenders directly. Another pro is leverage, putting less money in, being able to diversify. You know, if you have $5 million, being able to put $1 million into one project and $4 million into another project, as opposed to having to put all 5 into one. We're also, I mean, the biggest con is cost of funding, right? Non-bank lenders generally get their capital from wholesale investors, from institutional money markets. Sometimes some do from retail investors too. And there's a return premium that they need to pay to those investors. And there's also a premium that they need to generate in terms of margin to be able to run their operations. They're not big behemoths who, like NAB, who have shareholder capital sitting behind them and basically unlimited resources. They're businesses that need to be funded by the project and by the loan that they write and deliver the right risk-adjusted return to their investors. So that demands a premium. But I am really of the opinion that premium that you pay in non-bank financing is well justified by the service level that you get.
You said before about the shift from typical, your top 4 major banks, now, non-bank lenders. How long's this shift been going on for? When was the shift?
We really started shifting clients to that we started presenting non-bank solutions as valid solutions for our clients through COVID. Banks pulled out. But even pre-COVID, 2018, 2019, we were really implementing non-bank lenders into our clients' portfolios because our clients are all bullish, right? And they all want to trade and they all want to do things and they're all aggressive and they either want to save on interest, so they want to go faster, they want to move faster, they want to change asset class, and they want to do things, and we can move with them. And as a business, we're bullish, we move quick, we like to be in it, and we like to do deals, and we like to transact, and we like to solve problems. And so non-bank lending really solved what it is that our clients wanted and solved the problems that our clients had. However, higher interest and financing costs aren't sustainable. Well, whenever we work with a client, we really focus on getting the non-bank lender in for a specific purpose and then refinancing it at the end and getting it back into a major bank, because there's just not enough competition yet to drive down tighter margins between bank and non-bank financing.
Staying informed, as non-bank lending continues to grow in Australia, how would you say that individuals would be staying informed? Is that, reading the AFR? Is that, following market leaders in the industry in certain asset classes, speaking to your, real estate agents, speaking with your non-bank lender?
It's hard, right? There's, like I said before, whether the statistic is accurate or not, there's 600 non-bank lenders in the market. it is very hard to keep pulse on all 600 of these non-bank lenders or all lending products in the market. For us, it's easier, as debt advisors and at Dig Capital, our job is our whole team. They meet with 3 to 5 to 10 non-bank lenders every week. So we have deep relationships with these non-bank lenders, and we're always in tune with what their credit policies are, what they're writing, what they're looking for, where they're bullish, where they're not, where they have price differentials, where they have efficiency. And so, the only way that I think a property investor or property developer can genuinely be informed with the non-bank market and how it might have a positive impact on their portfolio is through debt advisors. But also you could read the AFR and you could read the Australian. At the moment, the AFR has a mixed view on private credit, but that's more from an investment standpoint as opposed to a credit and underwriting standpoint. And what matters to borrowers is what's the credit policies sitting behind private credit as opposed to how are people investing in private credit, right? There are a few conferences that happen into a market, but generally speaking, if your focus is property development or property investment, go to an advisor, go to your commercial lender, or go to whoever you normally go to facilitate your financing, and they should be well informed.
We often hear the phrase, debt is your friend. What opportunities can debt offer for developers?
Listen, that is your friend. I'm seeing everywhere, whether it's a shorts video saying that is your friend and you should leverage up and you should buy cars and you should flip cars, or you should leverage up and buy crypto, or it's an AI generated video that articulates that is your friend. It's a word and it's a phrase that's thrown around so willy-nilly in the market at the moment. That ultimately gives you the capability to do more. Right? It allows you to scale your business. It allows you, if leveraged correctly, to grow at a more efficient pace. It allows you to buy more trucks, hire more people, buy a property, build a factory for yourself, go at a faster pace than what you'd be able to normally go to with cash only. But that needs to be used correctly, right? And that needs to be used for a specific purpose. If you're releasing equity against the property that you own unencumbered, and that equity was meant to be used for a deposit on a new property development site, well, then use it for the new property development site. Don't use it to go to Europe for 12 weeks, right? And it needs to be used in the right way to get the right return profile. If you think about it logically, you have projects. When you're buying a project, you're looking at returning a higher you're looking at making profit on your equity, right? You're looking for a return on your equity. All that does is give you a constant, reliable source of capital to be able to maximize your return on equity through all stages of the project. So used correctly, it's definitely your friend. Used the wrong way, in particular with non-bank lending, it can very, very quickly become your enemy. And I guess that plays to the point that we raised before. How do you navigate that market? You need to know.
Be informed.
Be informed. Understand where that can add value, where it doesn't add value, what part of your portfolio it should sit within, what purpose it should be used for, how it can add value to your business, how it can be used to help you grow and scale, or how can you use it to buy the rainy day and survive those troughs in your business and survive those hard times. And it's really important to consistently be informed and work with your advisors in a very informed and deliberate and concise way to get the best outcomes from there.
As well as a debt advisor, you have been an avid industrial property investor and developer. As a client looking to purchase industrial property, what qualities do you look for in an agent, in an agency, when you need advice?
Real estate agency is a fascinating industry. It's naturally conflicted, right? You act for the vendor and you act for the buyer, and sometimes you act for the buyer and you act for the vendor, and sometimes there's a bias towards the buyer because their buyers bought multiple properties from you, and the vendor, this is the first property you're selling for them. So how do you manage those relationships? And so as a firm, we really look for agents who know how to navigate that underlying conflict accurately. And with diligence and with a long-term view and with a relationship-driven bias. We look for master negotiators. What we refer to as a master negotiator is someone who genuinely looks for a way to create a win-win-win. Win for vendor, win for buyer, win for agent. What that means, though, is that agents need to, understand the market. They need to understand zoning. They need to understand regulatory changes, especially at the moment with all the planning changes that are happening through the VPA. They need to understand how to navigate personalities. They need to have high EQ. They need to not be emotionally driven. They need to be able to think logically in times of stress, because some of these transactions, there are high dollar figures, buyer side, vendor side, and commission side. So how do they navigate that? We look for agents who look to unlock and add value to property, who see past the noise and see and really have that long-term trend view and that long-term arc view. You know, as a firm, we look extremely long-term. So we're focusing on partnering with agents who look long-term. We're very specific with the agents that we deal with, even those who refer business to us, because we don't look for agents who just want to make a buck. We look for agents who are looking to add value to a buyer, who are looking to add value to a vendor, who are looking to add value to the transaction, who are looking to navigate the transaction from front to tail. So, I mean, I'll flip it to you. You're the agency. What do you think makes a good real estate agent? And
good real everything that what you've already touched on already. I think like transparency is just you know, being completely clear, looking past the deal. You know, what else that the vendor may be difficult to deal with.
Yeah.
But you know, what's past that in terms of what other assets do they own? How can we assist there? You know, it's a long-term play. You've got to think outside the box. Also, like we see for ourselves that at An Property, where we're specializing in, you know, in land sales. And then if you're selling that asset, you know, the long term, okay, so once they build it, once they buy it, what are they going to build?
Yeah.
Do they need help? Do they need help leasing it? Do they want to sell it? How's it going to take? You know, if they've got a business, are they going to move straight in? Do they need another asset to lease in the meantime?
Yeah.
It's just, you know, in that long term.
Well, it's a portfolio view, right? It's in Australia, generally, we invest in property, right? As soon as we make a little bit of money, we buy a property, and then we make a little bit more money and we buy another property, and then we make some money off our properties, and then we use our properties to buy another property. And so property is such an important part of everybody's portfolio, but with that, it's a long-term asset. It's not generally a buy and flip, but if the strategy is buy and flip, then you want agents who understand the metrics that sit behind the buy and flip, right? Like you were touching before. What are the planning overlays? What is the planning regulations? Are there Melbourne water overlays? Are there flooding overlays? How long is that all going to take time to get to it? Is there a way to de-risk it pre-acquisition, you know, in terms of finding an off-market buyer or vendor, or off-market buyer or tenant at the back of the transaction once the asset's built? You know, we look for agents who really do that and really focus on de-risking front end. They're
not just trying to sell an asset, though, you know, probably to someone that, you know, won't work for their business at all, because there's, you know, zoning regulations of how many people can work on a site at a certain time.
That's right. Exactly right.
How will AI impact the industrial property market in Melbourne?
Very interesting. AI is obviously everywhere in the market at the moment. There's a lot of AI generated videos in the market. There's a lot of AI generated trends in the market. It's an undertone. It's a hot topic, and it's a key topic that's been discussed in the market overall.
Yeah. Are you earning $85,000 a year and are you riding solo? Well, then this video's
exactly right. There's a lot of the AI.
Don't skip the ad.
Yeah, exactly. There's a lot of that AI sort of driven everything, content in the market. It's absolutely everywhere at the moment. How it specifically relates to industrial property, listen, I think that a lot of industrial property occupiers are really going to benefit through what AI can do. You know, AI can find, for example, the most efficient routes for trucks to drive from Melbourne Airport to Melbourne Port, and by finding that efficiency in the route, you know, it's going to unlock potential roads or that none of us looked at as arterial roads for property investment or property development, and they might create traffic areas there. It will unlock supply chain efficiencies. It will unlock understanding consumer trends better, which will allow businesses to better navigate their stock levels. And by better navigating their stock levels, it might bring more efficiency into how they store their items, and maybe that means that businesses need less footprints. But also AI is going to have a deep effect on consumers. And so what I mean by that is we still use retail, right? We still predominantly go to, you know, your Woolworths, is your Coles. We still do those sorts of things in Australia. Whereas you look at other countries in the world like China, they buy everything over their phone, right? They sell everything over their phone. Even America, you can get Amazon deliveries within an hour, within 90 minutes, within 30 minutes, within 60 minutes. It's a lot of this last mile logistics that technology and specifically AI is bringing into those markets.
And do you think that we're going to be moving that way, or do we still want that customer service face to face?
We're going to want the customer service face to face, but for 30% of what we do. The 70% of what we do will most likely be driven by technology and AI driven outcomes and one click to purchase solutions. I think Australia's come a very long way in terms of our logistics and how quickly we can get, stock from A to B. I do think brands like and businesses like Amazon have had a big impact on that, and in terms of sort of defragmenting, but also creating efficiency in our courier business and in our logistics business. And it's amazing to think that 5 years ago, we didn't have Amazon really to the level that we have today. And you'd buy something that would take maybe a week to come. Now you buy it and it's at your doorstep the next day. So these sorts of impacts are going to have a lot of impact on last mile logistics, supply chain businesses, logistics businesses as a whole. I do think there'll be a lot of impact for hard sand, soft sand, where we store containers, where we store our trucks, where we store our trailers, so it will definitely have an impact.
Do you think when you're saying demand for last mile logistics locations, close to the port, do you think there'll be a big demand for it because of what the promise is that we're trying to promise to the customers? For instance, Amazon trying to promise that we'll deliver to you within, 1 to 3 business days.
Yeah.
And so businesses will need to be in those locations to keep up with, your Amazons, for instance.
Absolutely, it's a competitive advantage, right? So if I'm buying something online, and I can only speak from personal experience, and it's something that will take, it's the same products, it's the same price, and one vendor is saying it will come to my doorstep within 24 hours, and other vendors are saying it will take up to a week, and I have to pay express shipping for it to come within 24 hours. I'm going to go with the solution that gives me a 24-hour delivery time. And businesses are going to have to adapt and adapt their industrial footprint and their storage footprint and their commercial assets closer to arterial routes, closer to major infrastructure hubs, closer to that last mile sort of mindset, so that they can maintain a competitive advantage moving forward. If you just look at it, and I'm not saying this is happening, but if you look at businesses like Myer and David Jones, I do think that one day there'll be an online competition in terms of who can deliver quicker, who can deliver faster, who can have a more efficient logistical footprint, who can serve that last mile better than their competition. So it might not be as prevalent at the moment as it is in Australia, as it is overseas, but overseas it's a massive trend. And that trend will come to Australia because we're quite progressive as a demographic, right? We're quite a progressive nation, but we just haven't caught up yet at where the rest of the world is technologically, absolutely.
What are your predictions for 2025, and how do you think the upcoming election will affect debt markets?
2025 is going to be a very interesting market. I do think Australia's going to continue this two-speed economy that it's running. I do think that interest rates will come off another 50 basis points, 25 to 50, at least 25 basis points, but potentially up to 75 basis points over the coming year. I don't think much will happen before the election. I do think 2025 will be a year where Australia shines globally, right? We are quite a stable country. We're one of the last rated AAA sovereign graded countries in the world. I think Southeast Asian investment will start coming into Australia significantly over the coming year, 2 to 3 to 4 years. So that will drive more liquidity into the market. It'll be very interesting to see what America does and the impact that tariffs have. But also what's happening in Europe, will Europe be more politically stable? Will Germany find its feet? Will capital markets find their feet? Election, it puts a lot of short-term pressure, volatility, and uncertainty on debt capital markets. What investors will be looking for is fiscal policy, taxation policy, regulatory mandates. They'll be looking for where the new government and new coalition will be spending. If there is a new government or coalition, I'll reserve my rights on that. But as we saw most recently as COVID, markets adapt quickly. So once the election passes, the market will adapt quickly. There'll be more certainty into the market, and we should see a better cadence in terms of how the debt markets are reacting overall.
Well, thank you, Faris, for this really informative discussion. I feel that we covered multiple topics, and it was great to hear your predictions and insights. If you're looking for greater insight in the real estate market, specifically in financial brokerage in that sector, you can get in touch with Faris, and I'll leave his contact details in the video description. And thank you again, Faris, for inviting me into this beautiful office on Collins Street. It was great to catch up.